It's everywhere. It's all everyone's been hearing about recently. It's one of the world's newest and hottest tradable assets. 600% gains, 100x returns, hundreds of thousands in profit. There are countless videos, tweets, and articles sharing their stories of how they became an overnight millionaire, stories of unbelievable speculative success. But they all share the same underlying message. Jump on board now before it's too late. Buy now, hold on for dear life, and to the moon. But is it really that simple? Is it really a get out of jail free card? Can it honestly be that easy? You just pick a coin or pick a token, dump your money in, and wake up with more zeros than the Matrix. The truth is, it's not. It's far, far harder than you think, or that any of the crypto and NFT gurus will have you believe. They love parading the glorious returns that are possible when trading these assets. But they skip over all the important parts, the little details that could possibly lead to financial disaster. I'm all about honesty. That's what this channel's about. I say it how it is. No sugarcoating, no white lies, just the raw and honest truth. And if you're interested in trading systems, NFTs, crypto, subscribe and follow our Twitter at Cosmic Delta OG. Now, I've gone through hundreds of articles and dozens of videos on YouTube about how to trade NFTs, and none of them ever reveal the real difficulties of trading this new asset class. First of all is the cost of trading NFTs. Most videos on YouTube will show you how to buy an NFT. They'll run you through the process and then talk about what insane gains you can make, and promise with just a few simple steps you could make hundreds of thousands just like them. But if it were really that easy, everyone on the planet would be a billionaire and there'd be a huge inflation problem. The truth is, you need a lot of money to make money trading NFTs. You don't stand a chance at turning $500 into tens of thousands, or turning $1,000 into 6 digits. It just won't happen, I'm sorry, unless you're stupid and lucky at the same time. And here's why. Think about purchasing shares of stock. In order to buy the stock, you'll need to pay a brokerage fee, and this is typically less than $20, or in some platforms now it's even free, like eToro. There's no brokerage fees. Think about trading over-the-counter derivatives, such as Forex. You pay a spread as a form of brokerage fee, but it's usually an extremely small amount, less than 0.5% of the position size. But that's not the case for trading NFTs. Every time you trade an NFT, you have to pay the gas price. Now, the gas fee is effectively the cost of interacting with the Ethereum blockchain. This price varies with the current usage of the network throughout various times of the day, and also varies with the price of Ethereum. The problem is, however, that recently gas prices have risen extraordinarily. Could be even up to $100 on some trades. $100 every time you buy or sell. That could be up to $200 in brokerage, so-called brokerage, every time you trade one NFT. Now let's say you bought a very cheap NFT for $5 or $10. You would need to make 4,000% or 40x just to move to break even. Now there are ways around the problem of extremely high gas fees. There's the anticipated release of ETH 2.0, which could alleviate these issues with gas fees. Or alternatively, you could bridge your ETH to another coin and trade tokens built off those networks with lower trading costs. But if you're set on a token listed on the Ethereum network, try trading at off-peak hours or hours late into the night when gas prices should be lower. Now, the next issue of trading NFTs is the problem of liquidity. One of the first things quantitative funds look at when deciding which markets to trade is liquidity. In simple terms, liquidity is there enough buying and selling going on that if I wanted to get out of a position, I can actually get out? Hedge funds aim to never have more than 1% of the open interest in any given market. Otherwise, they'll begin to encounter problems with exiting trades. Now, this is a huge problem for NFTs. For most tokens, holding a position will give you a huge percentage of open interest in the asset. This means that you might not be able to get out at the time that you want, and you might be stuck holding a token that's crashing with no way to get rid of it. Even the biggest names in the NFT space have a relatively small daily volume when compared with crypto or other more liquid assets. This is a very, very serious issue when trading NFTs, and it makes it incredibly hard to have any sort of strategy when trading these types of tokens, which leads me on to the next issue, which is a lack of data. Good, reliable, historic data is essential when creating a quantitative trading strategy. It's not enough to come up with a good idea and a good set of rules, and then apply it to your actual trading account. You need to see if that idea that you've come up with actually works. You need to backtest your system on past data. Statistically, you want to test whether your strategy will work through many different economic cycles or regimes. Growth and recession, inflation, deflation, stagflation, high and low interest levels. To capture all of these in your backtest, you'd probably want to test your strategy stretching back possibly even as far as the 1970s, 50 years of data. The problem with trading NFTs is you're probably only going to have a few months, even a few weeks of data. This is too unreliable. There's no way of knowing how the token will react to a major news headline, or global macro pressures, or government policy. In these cases, trading NFTs is really akin to a gamble, where the odds aren't really in your favor. And the final risk I want to bring up of trading NFTs, I consider to be extremely important, is the risk of basically all decentralized finance, DeFi, by definition, has very little to no regulation. This can be a good thing, and it's one of the strongest points when it comes to DeFi and crypto, but it comes with many dangers too. For starters, NFTs and crypto have no circuit breakers. Other financial assets and derivative products have built-in circuit breakers. This is a measure to effectively halt panic selling in extreme market conditions. It's like a safety net for when the market plunges. On the similar note, the futures markets have a limit up, limit down mechanism, so the price is only allowed to move within a certain range each day. There's no such thing though with crypto and NFTs. It could go from trading at 1,000 to 0 in seconds. There's no circuit breaker to stop it. Take the recent crash from the Squid Game coin, for example. 230,000% gains wiped out in moments. And with crypto and NFTs, there's also no margin call, no opportunity to provide further funding. It's instant liquidation, your money gone. People forget that while a token can make absurd gains, take SHIB for example, 80 million% up in the past year, it only has to lose 100% to go to 0. And in DeFi land, there's nothing to stop it from doing so. That's all for today. If you enjoyed the video or learned something new, please like and subscribe to our channel. You can also find us on Twitter at CosmicDeltaOG, where we cover everything about quantitative investing, crypto, altcoins, and macro.